Nest look after work-based pensions for around 12 million people. They're one of the fastest growing pension companies on the planet and have 30 billion in assets under management at the moment, which is forecast to rise to 100 billion by the end of the next decade. So when these guys make changes to their fund lineup, it affects a lot of people. A couple of days ago, I started getting loads of people emailing me asking me if I'd seen the latest changes that Nest has made to one of its 6 funds. Alongside the email, we got these FAQs. I've read both and I want to run you through them and just expand on them a bit because if I'm being honest, I think in many areas the explanation is a bit lacking. I will also look to provide context as to why Nest might be doing this, and we'll look at what options you have if you're with Nest at the minute. So what are the specific changes? As of the first week of November, Nest are taking 30% of their Sharia fund and investing it in something called Sukuk. I'm sorry if I said that wrong. But they're basically a Sharia-compliant version of a bond. A Sharia fund is a fund that's aimed at investors who wish to invest in accordance with the Islamic faith. But plenty of people use this fund, myself included when I had a full-time job, not because of the religious lean, but because it's the only fund in Nest's lineup of 6 funds that gives investors 100% equity or 100% exposure to the global stock market. Creaky desk needs an oil. Every other fund Nest offers has some allocation towards bonds, even the high-risk fund, which is the most adventurous fund in the range but only has 70% equity. Granted, there's property and commodities in here, but you'll notice in the top 7 funds that 2 are bond funds and there's also private credit in there. So why are Nest changing the allocation in this fund? It's always been our ambition to diversify the Nest Sharia fund, as our investment ethos is based around diversification and the benefits that come with it. When we launched the fund in 2011, we weren't able to invest in Sharia-compliant diversifiers because they were just too expensive. So Nest's overall belief is in broad diversity of assets, and this stacks up. Every fund on their platform that isn't the Sharia one includes bonds, commodities, and property allocations. They go on to say that your pension savings will be better protected from potential falls in the stock market, as we're spreading your risk across different types of investments. So here we have the centre of the issue. Nest see this Sharia fund with its 100% equity exposure as too risky. And what they mean by that is there is too high of an exposure to equities. The issue is plenty of people are purchasing the fund for its 100% equity position because they are after that exact thing. I'm 100% equities in my pension, so I invest through a SIP. I buy a global index fund because my retirement pot is the amount of cash that I have in my life with the longest timeline before I need to use it. So I want to give it the best chance of growth, hence exposure to equities. I personally don't like how they frame the Q&A, the Nest response, and even just the wider discourse around risk in the finance world. This whole "we want to prevent you from drops in the stock market" thing. To an uneducated general user of a pension product like Nest, avoiding drops in the stock market sounds ideal, doesn't it? But this is focusing on the wrong thing in my opinion. The stock market is like someone playing with a yo-yo while riding up an escalator. The trick is to focus on the escalator, not the yo-yo. Everyone's appetite for risk and short-term volatility is different, but people are selecting this fund as it's the only one that offers 100% equity. My personal view, again, not yours, this is just me, but if I'm in my 20s, 30s or 40s, forget about the yo-yo. Forget about the short-term ups and downs of the market. In fact, welcome drops in the market. Because when I'm young, that allows me to buy more units of the stock market at a cheaper price. You should only really care about the yo-yo, if you will, about the ups and downs of the market when you're about to step off the escalator, because that's when things can get a bit messy if you time it wrong. I could forgive this approach. I could forgive this cautious short-term focus of Nest inside of a long-term investment vehicle if the answer to the next question wasn't so poor. How will this affect performance? This helps us balance risk with return. In terms of real returns, members should see more stable growth. More stable growth, excellent. Again, another generic line that to the uneducated sounds like a good thing, but I think that it should have read like this. In order to reduce the short-term volatility, we expect the fund now to grow less overall in the future as we're reducing risk, which is likely to reduce return. Past performance is no guarantee of future performance, and in a second I'll give some counter discussion that might actually justify Nest's actions. But let's look at the difference in total returns, the amount you would have in retirement, based on previous year's performance. Since 1978, the return of the global stock market as measured by the MSCI World Index is 10.4%. If you invested £300 a month every month for 46 years, which is a working lifetime, and achieved that rate of return, you would have around 3.4 million in retirement savings at the end, assuming that the compounding rate is on an annual basis. Okay, now let's look at the same investment over the same timeline, but with a portfolio that has a 30% allocation to bonds. The past performance numbers here aren't as easy to get. It depends on, the bonds that you use and stuff. But I took a look around and there are suggestions online that the average performance of that fund, that 70-30 fund, was between 8.18% and 9.2%. Let's do both. Starting with the 9.2%, which is a little over a 1% fall in performance. I mean, that doesn't sound much, does it? Well, it would cost you about £1.1 million. At 8.18%, it reduces the portfolio size, the amount you have at retirement, by more than half, leaving you with £1.6 million. I need to be really careful here because I can't use past returns to project forwards, but I really just want to ask Nest if they think this explanation right here, you'll see stable growth, is a sufficient explanation of how returns might be affected by this decision. I don't think that there is. Before I get all ranty on this, let's just for a second look at the other side of the argument and go, is there any sense or logic to this decision? And why are they making it now? Is there an investing argument? Is there a debate around the fund doing better? The Nest Sharia fund is currently dominated by US-based technology stocks, such as Apple and Microsoft, which have performed well following the boom in artificial intelligence. However, stock markets can be volatile and can incur losses during downturns. This to me reads like they're worried about an AI bubble or overexposure to tech in the fund. Sharia funds have outperformed recently compared to their global counterparts due to the fact that they tend to have a bigger tech focus, as they remove sectors like financials, which include banks, and other sectors that don't meet their screening process. As an example, Nest Sharia fund has a 7.7 exposure to Microsoft, the largest holding, whereas VWRL, Vanguard's global fund, it sits at 3.9%. Sharia, by virtue of its exclusion of specific sectors, has benefited greatly from the boom in tech in recent years. But this also means if there was a pullback or a bubble, like an AI bubble, Sharia would be overly exposed to that as well. So maybe Nest think that Sukuk will protect from this downside. The idea of including bonds within a portfolio is to act as a dampener to limit the severity of stock market crashes. But there have been these long stretches of time in recent history where the stock market has underperformed bonds. One well-known example is the period from 2000 to 2013, which included two major bear markets, the dot-com crash in the early 2000s and the 2008 financial crisis. During this time, the S&P 500 delivered minimal or even negative returns, meaning bonds outperformed. There's been a report from Goldman Sachs doing the rounds where they forecast a 3% annual return for the S&P 500 over the next decade. At the same time, higher interest rates now mean that the long-term outlook for bonds is better than it has been in previous years. Moving away from the S&P 500 then might be a good idea. But let me just remind you of something, please. December 2022, Goldman Sachs estimated that the S&P 500 would finish 2023 at 4,000, but the index actually ended up 19% higher than their forecast. In December 2023, Goldman estimated the S&P 500 would finish 2024 at 5,100, but the index is currently 14% higher than that right now. Goldman Sachs, just like every person, body, research group, or company, have absolutely no idea which way the market will go tomorrow, let alone in 10 years. I highly doubt, or I hope, that Nest are not being swayed by such research. I think it's just the first point, that they're bringing the Sharia fund in line with their overall investment approach. And I think how you view this boils down to how you see Nest or what you think their duty is to their customers. Do you think it's to maximise returns, to get the most for everyone in retirement, or is it to get as many of their customers to retirement as possible in a way that produces not too many shocks or heart attacks along the way? Because I will concede that it's very easy for me to sit here going 100% equity till I die when I've not really experienced a protracted decade-long underperformance of stocks. If I was living through that now, would I change my tune? Potentially I would. But I like to think that I wouldn't. But I do think Nest probably sit there and have this view that smoothing out the ride for their millions of users, many of which are not really up to speed with the stock market at all, is a better option, is their thing that they should look to achieve. The inclusion of bonds in a portfolio tends to smooth out the variance of returns. What I mean by that in Nest cases, where their customers ends up, tends to be a bit more predictable. This chart plots all of the outcomes of an investment just into American stocks, 100% equity if you will. Whereas this is something called the Coward's portfolio that has 40% bonds. Notice the spread or thickness of the chart is much thinner. So for Nest, they might prioritise this predictability, this ability to try and get people to retirement in a predictable range, even if that means they sacrifice potential returns to do so. As Nest charge a percentage fee, they make more money the more money that you have on the platform. You would think then that they're incentivized to encourage people to have the biggest pots possible so that they can collect more in fees. But it would appear that this diversity point really is at the core of what they do. And, I guess that's up to them, right? But it's this last bit of the Q&A. Why didn't you keep the all-equity fund and create a new Sharia fund with diversification? They repeat the same thing about long-term volatility, but then it's just this line here. We recognise that some members have chosen this fund in order to invest their savings in company shares known as equities. That's it. Yes, we know. Next paragraph. To me, this bit is probably the most infuriating. You run a platform where the millions of customers that you have are essentially forced to use you so that they can access the benefit of a matched contribution from work. 99% of them have no idea what you do with their money. But the 1% who actually do, the 1% who take an interest and go, hold on, based on past performance and data, I should probably be exposed to the stock market as much as possible to improve my chances of returns. You give such a poor selection of funds to those people that the only option for them is a fund with a religious lean. They use it, you acknowledge they use it for this reason, but then you take it away, go, yeah, we know, but look at this yo-yo. Nest charges 1.8% contribution fee on top of fund fees of 0.3%. This is a premium product that costs a lot of money over a lifetime. The simplest thing to do here is just to offer a 100% equity fund, isn't it? Your customers clearly want it, and it's their retirement. If you're in a position whereby the fund is being removed from you, I am sorry. Nest is one of the more restrictive schemes out there, it seems. They do not allow partial transfers into your own pension, as far as I'm aware. Let me be crystal clear here, though. I still think you should be in the scheme rather than not be in the scheme because of the tax benefits of paying into a pension and because of the match contribution from your employer. This is as close to free money as we get in the investing world. But I would raise this with your employer just to express the frustration. I've also, with the help of ChatGPT, put together a letter template link below that you can use if you want to contact Nest directly. I've included a contact email as well if you want to send it as an email instead. I'll also use my reach and influence to attempt to affect change here. I've reached out to Nest directly and asked for comment on this, but I won't let this go until we get a satisfactory response from them as to what's going on and what people who want 100% equity within their pension, their retirement, can do about this going forwards. I'll speak to you soon and I'll keep you updated. Thank you.